Hello and welcome to Startup Slots, your favorite podcast about everything entrepreneurship. Today we are talking about big topic, fundraising. And because there is so much information we want to share with you, we decided to try a different format. So, we are going to split this episode into two parts, and today you will be enjoying the part one of startup fundraising. As you know, fundraising can make or break every startup. So, today we are covering the whole journey from being a baby startup into becoming an international billion-dollar company. And throughout our founder's journey, Xenia and I have seen a lot, heard a lot, experienced a lot. So everything we are sharing comes from our own experiences. And also, at the beginning of our journey, we read a very helpful and interesting book from Tim Weiss called Startup Fundraising. And we highly recommend you to read the book and also to listen to our podcast episode. So grab your pen and paper or notebooks or whatever you find helpful, and let's dive deep into fundraising.
Welcome to Startup Sluts, where we keep it real. No sugar-coated stories, just the raw deal.
I'm your host, and today we are tackling a question that every founder faces at some point. Is fundraising the right path for my startup? Before you even think about creating a pitch deck or scheduling meetings with investors, it's crucial to ask yourself if taking on investment capital is the best move for your company. There are other ways to finance a startup, such as applying for government grants or bootstrapping, which means funding the business from your own revenue. So, let's dive into the potential downsides of fundraising. It's not all glamour and big checks. First and foremost, fundraising is a time-consuming and labor-intensive process. You should be prepared for it to take anywhere from 5 to 6 months. And that is a significant amount of time you could be spending on product development, for example, or sales. Second, there is no guarantee of success. You could invest a huge amount of time and energy into the fundraising process and come away with nothing or show for it, as has happened with our startup. And that leads to the next point. The average probability of success is very low. A large number of startups fail to convince an investor to back them. But if you do succeed, be prepared to give up a share of your company in exchange for their money. Because investors receive equity in your startup, and this means you'll own a smaller piece of the pie. You also give up a degree of control over your startup. Investors will want a say in major decisions, meaning you won't be able to make all the calls on your own anymore. It's also important to remember that this is a temporary partnership. Investors are typically looking to exit their investment. And as a rule, it is within 5 to 7 years. This means they will want to sell their shares, which could put pressure on you to sell the entire company. So, if you are not comfortable with the idea or eventually selling your startup, taking on investors might not be for you. Finally, it is very important to remember that not all business ideas are attractive to investors. They are looking for startups with the potential for high returns. This usually means a business that can serve a large market and grow quickly. An application, for example, is highly scalable, or a single restaurant, on the other hand, is not. So, if your startup doesn't meet these criteria, you may struggle to attract an investment.
Now, after hearing all of that, you might be wondering why any founder would choose to fundraise. Because there are still some significant advantages. One of the biggest is the high risk tolerance of investors. They are often willing to invest in a startup at a very early stage, right after its funding, making them one of the few available sources of financing at that point. Investors also bring more than just money to the table. They offer support and guidance. Their advanced and practical help can be invaluable in avoiding common mistakes and accelerating your growth. This type of financing, which includes money plus support, is a unique benefit that other financing instruments don't really provide. Compared to banks and public funding agencies, investors often faster access to cash. They can make decisions much more quickly, especially when they are already invested in your startup and you need additional funding. Next, the decision-making process is also more straightforward. While banks require extensive applications and feasibility studies, investors often just need to see a compelling PowerPoint presentation. You will also find that investors offer flexible conditions. They can be very accommodating when it comes to structuring the investment. And if your startup generates a lot of interest, you can secure very favorable terms. A huge advantage is that no collateral is required. Banks almost always require security for a loan. If your startup does not have any assets to offer, like your house or the house of your parents, you won't get a bank loan. Investors, however, are willing to provide capital without this. And finally, there is no personal liability. If you were to take out personal loan from a bank to fund your startup, you would be personally responsible for repaying it. With an investment, that's not the case. So, after weighing the pros and cons, if you're confident that raising money from investor is the right move for you, it's a crucial thing to plan the fundraising process carefully. The high rejection rate for startups is often because founders go into it without the necessary preparation and a clear strategy. So let's open the playbook. We're about to break down the fundamentals of the fundraising process, equipping you with the knowledge to make your first move.
Startup's funding journey is not a one-time event. It's a series of distinct stages, each with its own goals, challenges, and of course expectations. So let's answer one of the most important questions. Why do startups raise money in multiple rounds instead of getting one giant check at the beginning? It comes down to risk and valuation. For investors, providing a smaller amount of capital initially reduces their risk if the startup fails. For you, the founder, this is also a huge advantage because in each subsequent funding round, you can command a higher valuation of your startup, which of course minimizes the percentage of the company you have to give away. So there are the 5 main financing phases: pre-seed, seed, Series A, Series B, and Series C, also known as the 5 stages of founder grief: denial, anger, bargaining, depression, and a term sheet. Okay, let's start at the very beginning with the pre-seed phase. At this stage, your startup is still just a baby. The team is usually just you and your co-founders or co-founder, and you are working on developing the product and preparing for your market launch. The capital need is relatively low, mostly covering your living expenses, and maybe a small office. The goal of a pre-seed round is very simple: to get enough funding to bring your product to market. Readiness, of course. In Germany, early-stage startups often seek public support through, for example, government grants or startup scholarships like exist, or local incubator programs to bridge this initial phase before external investment. Next up is the seed phase. At this point, your product is on the market and you've likely hired your first employees. You are no longer a baby startup. Think of this phase as starting kindergarten. You are learning fast, tasting the water. You are building the foundation for growth. Your focus now shifts to adapting the product based on customer feedback. You are searching for what is called product market fit. Your revenue might be small or non-existent, but your costs are higher due to staff and customer interaction. The goal of seed funding is to give you the runway to find and prove the product market fit. Once you have achieved that, you are ready to Series A. This is a major step up. With product market fit confirmed, you now need to build the infrastructure to growth. Think of this phase as entering high school. You figure out who you are. And now it's time to specialize, get serious, and prepare for the big leagues. This means investing heavily in expanding your team, also creating different departments, and establishing formal hierarchies. The goal is to scale up your operations to win and support customers on a much larger scale. Your capital need increases sharply here as you aim to prove with substantial revenue that a larger, profitable market exists for you, for your product. Now we move into what's called the late stage, starting with Series B. And now you are in your university years, baby. Hoop hoop. The focus here is to scaling and professionalizing the business. You are likely saturated your initial market, so it's time for major expansion. This could mean entering new countries, targeting new customer groups, or adding significant new features. Your revenue is growing fast, but your burn rate, the amount of money you are losing each month, is also likely increasing as you invest aggressively into this growth. The goal is to successfully execute this first major wave of expansion. And finally, we have Series C, and of course beyond. At this point, you are a working adult. Here is the primary goal, is rapid revenue growth. You are continuing the expansion activities from Series B, but on an even greater scale. This might involve opening more international offices or even acquiring smaller companies. For example, in the US, a Series C round is often seen as a final step before an initial public offering. The ultimate goal is to transform your startup into a mature, self-sustaining company that can finance its own growth.
Of course, the path is not always smooth. Problems can pop up at any stage as your baby startup grows. Sometimes we whoosh through the money faster than expected, and you don't make it to your next big funding round. So your existing investors might provide a bridge loan to keep the company running until the next round is secured or a planned sale goes through. The second, more serious situation requires turnaround financing. This happens when the startup has fallen significantly off its growth path and can't attract new investors. Existing investors might step in with capital under very strict conditions to help the company get back on track or, at the very least, reach profitability. It's a last-ditch effort, and the terms are often very tough for the founders. So there you have it, the fundraising roadmap from a simple idea in the pre-seed phase to a global enterprise in Series C. Understanding these stages is critical because it tells you exactly what kind of investors will be looking for at every step of your journey. Okay, now let's start with the private investors. Of course, your very first investors are your family and friends. But now we are focusing on the first round of professional investors, business angels. So, who are they? Business angels are wealthy individuals who invest their own money into startups. Often, they are successful entrepreneurs themselves, seasoned executives, or experts in a particular field. And because it's their own capital on the line, their motivations can be more than just financial. Of course, they want a high return on their investment. But many angels are also driven by professional goals. For example, they enjoy mentoring or they miss the excitement of a startup's early days. Or they want to support a cause they believe in. Early stage startups, remember, business angels are the lifeblood of the pre-seed and sometimes the seed phase. They are willing to write the first check when the company is little more than a great team and a promising idea. Some particularly active investors might even participate in larger seed rounds. Not in Germany as a rule. In Germany, business angel investments often start as low as 5K. One German angel investor, for example, shared with me that they limit himself to no more than 4 investments per year, each around 25K. That's why German angels are typically a better fit for the pre-seed phase. And even for 25K ticket, some may already expect to see early traction before committing. Nevertheless, if your business angel is the right one, they can be far more than just a source of cash. They bring industry experience, open doors, offer invaluable advice, and connect you with the other investors. These are exactly the kinds of partners you want on your side. Their decision making is also much faster than institutional funds, often based on gut feeling and their assessment. Now, let's talk about the institutional investors. This is where the game changes. The key differentiator is that they are not investing their own money. They are investing on behalf of others. So the most common type you will encounter is the venture capital, or VC. VCs raise money from limited partners like pension funds, insurance companies, or wealthy families, and invest it in a portfolio of startups. Understanding their structure is crucial to understanding their behavior because a typical VC fund has a 10-year lifespan. The first 5 years are the investment period for funding new startups. The last 5 years are the investment period for helping those startups grow and, most importantly, exit. This structure creates immense pressure for a profitable sale within a specific time frame. Okay, now let's answer the question. What are their main goals? Unlike angels, the goals of a VC are almost purely financial. Their strategy is based on a portfolio approach. They know that most of their investments will fail. They rely on one or maybe two massive successes, the next Google or Facebook, to return the entire fund and generate profit. This means they are looking for businesses with enormous growth potential and a clear path
to a massive exit. If your startup can plausibly become a $100 million company, it's likely not a fit for a large VC. Next, VCs typically enter from the seed stage onwards. The size of the fund determines their focus. Micro VCs might focus on seed and Series A, while larger multi-billion-dollar funds won't even look at a company until it's ready for a massive Series B or C round. Having VCs on board can offer you an extensive networks, deep operational support in areas like hiring and strategy, and critically, the ability to lead and fund future, larger investment rounds. Their decision processes, however, is much slower and more structured than an angel's, often taking 3 months or even more. Beyond traditional VCs, there are other important players. Corporate venture capital, CVCs, are the investment arms of large corporations. They seek both financial returns and strategic advantages for their parent company. A CVC can be a fantastic partner, offering access to a huge corporation's resources and customers. But be careful, their strategic goals can create conflicts. They might push for an acquisition by the parent company, which could limit your options and scare off other investors. There are also public VCs, which are backed by government funds. Their primary goal is often economic development, making them more risk tolerant, but sometimes offering less hands-on support. Family offices, which manage the wealth of a single family, can also invest. They are often opportunistic and can be very founder-friendly. Last but not least, founders also have accelerators and crowdfunding platforms on their radar. Accelerators like the famous Y Combinator, for example, are programs that offer a small amount of funding, mentorship, and resources in exchange of equity. They are great for startups in the pre-seed or seed stage and usually end with a big demo day where you pitch to a room full of investors. Crowdfunding on platforms like Kickstarter, for example, is about pre-selling your product. Your backers are customers, not investors. This is an excellent way to fund development and prove market demand, especially for hardware and gaming startups. Crowd investing, however, is different. Here, the crowd invests for a financial return. While it seems appealing, it can create a messy ownership structure that makes it much harder to raise money from traditional VCs in the future. So, key takeaway is this: not all money is the same. An angel investing their own cash in pre-seed stage has fundamentally different goals than a massive VC fund looking for a billion-dollar exit. Understanding this landscape is your first step toward building the right strategy and approaching the right people.